Hi folks, it's Aiden CryptoBirb speaking. Welcome to today's Friday webinar. It's a beautiful day, and very critical breakouts are happening in the financial markets, especially in the traditional finance on the cryptocurrency side. It's yet to come, and just maybe, if there's enough of follow through and enough of a fuel and steam left on the following week, cryptocurrencies may be on a big boom, a major rally. The setup is there. However, will Bitcoin break $35,000 soon? What are the chances? We're going to discuss this among the Dead City discussion. If you're ready to hear this and more, make sure you stay tuned. We're going to write in a second. How is everyone doing? This is Aiden CryptoBirb speaking, your host for today's Friday webinar. Welcome to this beautiful day. This is actually very, very amazing. Beautiful weather. Excellent conference, Wealth Global Conference that I just come back from. It was in London, UK. Beautiful London city places, Guildhall, incredible old buildings, beautiful. You British guys are pretty neat. I'm not going to lie. So well, lots going on. Possible move to $35,000, right? We're going to touch upon the Bitcoin price action analysis among many other different techniques and indicators, technical approach into market technical analysis. We're going to have a look at different markets. Well, if you have some questions, make sure you drop them in the comments. We're going to try to answer them either through the show or after the show along with my team. So do not hesitate to drop your comments. If you're watching that on YouTube, make sure you hit the subscribe button, smash the notification bells, hit the likes, hit the comments to get notified anytime. Basically, we go live, and there are plenty of opportunities for that. So, cześć, just that. Cześć. Hi, Lil Sten. What do you think about ledger hardware wallets in general after the backlash? Very good question. Right? So, I think it's nothing is riskless, right? Everything has a risk attached to it. Whether you store your money on ledgers, on treasurers, eventually there is not an ideal situation. It's about which kind of like a product for certain cryptocurrencies just works best for you, right? Otherwise, again, this is a very, very difficult one. We are not safe. We're not safe in bank. We're not safe anywhere else. So we don't want to get fooled. That's for sure, right? Let's firstly dive in deeper into what's going on in the markets, right? There are debt ceiling discussions, of course. This seems to have triggered a little bit of a rally into the weekend. Arguably one of the most critical rallies, one of the most important rallies as the traditional markets persist higher. Let's have a look on what's going on. All the major markets are in green. Every single thing is in green, and this is a powerful green. 2% on the Dow Jones Industrials Composite Index on the Nasdaq Composite is 1.10%, 2.6% Amex Composite. So strong, powerful move. Major indices are all in green. This is all in green right here, ladies and gentlemen. The stocks, all the S&P 500 sectors are all in green, right? The U.S. industry indices, except for gold, are all in green as well, and those are the powerful moves, right? Airlines 3.7%, almost 4% for the banks. Biotechs 1.45, broker deals 303, chemicals 335, right? So those are powerful movements. If you have a look at it, what's going on? Oil services 488% to the upside, right? Powerful moves. So this is one of those strange, not strange, one of those significant breakout days where the breadth is present, where the breadth breakout confirms the actual validity of the movement of it, right? So it's not just one particular stock, one particular name that goes up. It is a whole market, as a one big movement persisting in one direction. This is pretty incredible. Cryptocurrencies all in green. We're going to touch upon that a little bit deeper into the show. US dollar is rejecting the actual critical level of 104 points, right? We're looking at the US dollar. However, per the UUP, there's a little bit of a confusion, I would argue, right? There's some strange transaction going on. If we have a look at a closing dimension, right? There's this strange bar. I'm not really sure how to interpret it. What's really happened? We can actually just maybe have a look right there. If there was airlines, there was this one, bonds. While we're on bonds, right, it's a little bit of a mix. 30-year bond prices are up, the yields are down. What are we looking at? The 2 years are down. 2 years, the 2-year yields are down. So, well, overall, it seems to be a strong bullish day, right? Strong bullish day. This seems to be pretty particular. The VIX is definitely persisting to the downside, right? Significant breakout, and it's actually making new lows, right? I think that it's a long time since we actually saw this powerful breakout to the downside. So VIX is breaking down, right? And it's a powerful move. It's a almost 5% drop, right? Put and call ratio CPC minus 70%, almost, right? So those are big movements. This is a big turnaround in the market, big confirmation. That happens to be confirmed also by the, well, Dow Jones Industrials, like we discussed. There's a full movement, healthy movement confirmation in the Dow theory light, basically persisting, also breaking out on this local, again, Dow Jones Transportations, right? There's a little bit of a more powerful breakout within some, again, maybe chart pattern, maybe formation, maybe not, right? Regardless of what it is, that trend line seems to be broken locally, right? So some short-term trend seems to be breaking out to the upside. It's a positive thing, if anything. And here's, ladies and gentlemen, the most important chart, I would argue, right? So we're looking at a very significant breakout on the S&P 500. Like I said, all the S&P 500 sectors are in the green today. This is what rarely ever happens. This move is a whole stock market, a risk offensive cyclical market is moving up, right? Cyclical, well, yes, defensive stocks as well, right? So this is an overall stock market movement, like a big upward trajectory is gaining on momentum. And this happened to confirm the significant breakout, not only to the yearly highs, right? This is the highest the S&P 500 SPX large cap index has been this year, right? It's also breaking a significant, 4-month resistance of 4200s, right? 4200s has been this critical rejection level, which definitely brought a lot of stagnancy overall, right? At any time the prices got close to 4200 to get rejected, tweaked and bamboozled a couple of times, as I framed it. So overall, by looking at this significant break over 4200, and it's a powerful follow through, right? This is not a single point to question. It's 1.47% up. It's not by a lot just yet. However, the breakout is real, right? And we are definitely closing off the week very sharply and very strongly. This happens to be also confirmed that a relative strength chart, right? This is the intermarket analysis. Intermarket technical analysis helps you understand what is going on a relative basis. And relative basis is more often more valuable to look at and to admire and to basically draw conclusions from than the absolute price performance, right? So instead of observing one asset price, we can observe and draw more reliable conclusions by observing the relative strength ratios. And one of such is basically the XLY versus XLP, right? XLY XLP ratio. This is risk on versus risk off. So it tells you about the overall preference among the investors, right? If the chart goes up, it basically tells you that the XLY XLP ratio inclines. That translates to and that is caused by investors choosing the XLY risk offensive tactics, risk offensive stocks, discretionary stocks such as Tesla, such as something those more durable products, those high caliber products that are not of the basic use, right? So this only happens when investors feel really positive about the upcoming future, right? Otherwise, if you don't feel good about buying a car, if you don't feel safe about your future, you wouldn't be buying a car, if you know what I mean, right? So the powerful breakout has got the follow through. It's actually right now testing the yearly highs for the ratio. It's a very significant move, very powerful rejection off the lows, right? It didn't manage to kind of persist lower. Instead, there was a powerful flip, very powerful, breakout over the trend line, and hence the relative trend line of the 200-day moving average, representing 200 days of average prices on the relative basis, it's starting to curve up slightly. It's definitely slowed down and shifted the trajectory, the overall direction, and the ratio keeps climbing. This is bullish. Looking at the energy prices, we got a little bit of a very interesting signal, right? So the relative strength ratio is a very powerful tool because it often precedes the price movements. It often precedes the price movements, right? So if you have a look at what happened, this is just an example. However, by observing the relative strength ratio here, it's actually the energy versus the S&P 500. So you're observing the relative performance of the XLE of the energy sector, whether it underperforms or outperforms the S&P 500, to show you the actual strength on or weakness on a relative basis. So what we're looking at eventually is, first of all, by observing the actual technical analysis, same trend line, support, resistance levels, it can be used on a relative basis as well. So observing the relative strength ratio breakout, just like it says here, you were able to accommodate yourself into the actual lows of the base of the triangle base right here, of the symmetrical triangle, right? Before the major breakout happened. It often precedes the price breakouts, right? So see what happened here. When we're looking at the actual breakout here on the relative strength ratio, we also, well, most of the time happen to coincide at least or precede the actual breakout on the prices, right? So we've definitely been trending down to the downside, like ever since, well, basically since the year started, right? If you have a look at it. So since the year started, we've been basically going down on a relative strength basis. It tells you that there are very high chances that this actual consistent move down for the past couple of months, even more, is the beginning of a downward trend, of a major reversal for the energy prices that had been going on since 2020 COVID times, right? So this is a powerful, potentially preceding valuable signal indication, right? The new lows had recently been reached, on the relative strength basis, right? Showing significant underperformance of the XLE versus the S&P 500, while no new lows were printed on the actual energy sector, right? Absolute price. So what it tells you is that there are chances that it actually precedes the price, because if there is a weakening on the relative basis, if XLE underperforms the S&P 500, what it tells you is that the S&P 500 is more preferred as a better bet among investors. It means that investors would kind of like give up and give in their positions on the energy sector bets, right? Of course, it was a little bit of a positive, sharp move up today, right? So it's a little bit of a recovery. Still, what we're looking at is the new lows, territory, right? And the new lows territory on the price absolute basis has not been reached yet. So does it really precede the future, right? Just maybe, we're about to find out. Still, a significant slowdown has been going on for the past couple of months, right? The market is not really trending much anymore. The market has been moving in this overall sideways, kind of like a box, in this overall sideways rectangle, if you will. And this rectangle, has been hovering around 90 point, as in 90, 92, 93. Between this and on the lower end, between 60 to 63. So low 60s, low 90s. This is a base target, potentially to the downside, if we get below those lows, right? Below the swing lows of the past 2 years. If that happens, we may actually, on a measured rule technical basis, we may expect a move of a similar base, right? The measured rule movement would expect you basically to take and measure the base size, right? And take the pattern size and measure it to the downside from the breakout levels, potentially placing you somewhere in the lower 30s area. So if that happens, this could be bullish, right? Because continuously declining energy prices are going to translate to more money staying in your pockets. So if you think about that, more money staying in your pockets means that you can use that as your disposable income. You can dispose your income more effectively, more efficiently into financial markets, hence increasing the liquidity, increasing the demand, and pushing the prices higher. This is bullish. So in the meantime, please let me know how you guys are doing, where you're writing from. Beautiful weather here where I am right now. Let me know how was the weather, what you guys are doing at this very moment, if you're sitting somewhere in the garden or just perhaps taking a walk in the forest, or maybe you're busy in your office watching this very stream, please let me know in the comments. And regardless of where you are, who you are, this is definitely great respect to you guys, because you are you deserve the greatest respect for being here despite all the difficulties, all the bear market implications from the last year. You're here. You haven't given up, just like hundreds of thousands of other people did. Congratulations to you. This is well done. If we are to continue, right, with the energy prices potentially being getting closer towards the lower end of the range of an overall major massive slowdown and a massive sideways period that may be preceding the overall trend projection, trend inflection to the downside, right? If that happens, well, this may not only confirm the predictive power of the relative strength ratio versus the absolute prices, it may also contribute to your better portfolio allocation, right? Because just maybe if this promotes the risk of offensive tactics, if this promotes risk offensive portfolio allocation, there might be a better choice to, well, consider getting a little bit more aggressive about the investments this year, especially that 83 to 84 chances over 84 years, only 1 year that was a pre-election year lost. All the other years were bullish. All the other years closed higher than they opened. They were bullish. 83 out of 84 chances, you made money by buying at the beginning of the year and closing a position at the end of the year. You only lost once since Second World War. This is 98.8% of chances that if that is supposed to continue, then you're going to make money, right? So 98.8% of chances that you're going to make money by being bullish this year. Right? There's of course still a very strong and persistent. It wouldn't go away. It wouldn't fade away. Deep yield curve inversion, right, between the 10 years and the 2 years. So overall, the way I would argue, right, the 10 years and the 2 years should basically be normally different, right? Because the higher treasuries, the higher maturity treasuries should be technically paying out more. However, what happens when the yield inverts, right, is that the shorter maturities actually pay off more than longer maturities. This typically happens, well, due to the high pace of boosting rate hikes, boosting the interest rates from the Fed monetary policy. They are tightening the monetary policy, worsening the financial credit conditions, right? The borrowing becomes much more expensive and difficult. And eventually, again, it reduces the amount of business it slows down the business cycle, right? So it's difficult for the business. It's difficult, I would say, for the economy overall as it struggles. So this each and every single time basically, finishes with recession. And this is the deepest yield curve inversion since 1980s. So hard landing, ladies and gentlemen, this is probably what is going to happen. Perhaps it doesn't need to happen tomorrow, but it doesn't need to happen in 5 weeks, or maybe in 3 months from now. It may happen in 2024. Just like Fed would often tell you, and Chair Powell on the FOMC meetings, they would tell you that the full tightening results and effects are yet to be felt, right? The recession is yet to come, and some economic forecasters are actually pricing it in, somehow discounting it for the next year. And that might be the case, right? So the yield curve inversion, which historically had flashed and signaled as an interest rate spread as a leading indicator of the economic index, would basically tell you about the potential risks of recession not going away. Luckily for us, recessions can be bullish, right? Recessions can be bullish if you have a look at it. The performance charts, right? It gives you a little bit of an idealized model of the financial markets, where the orange curve represents the financial markets, right? This is the financial market cycle when there is a bull market on the left-hand side and a bear market after the inflection. And this happens to lead by 6 to 9 months on average the business cycles, the economic cycles, right? And the business cycles, 6 to 9 months difference basically tells you that, that from the moment that the markets persist or do certain price action, create certain hole or create certain valley, peak, valley, trough, whatever you name that, the economy is going to react with much lag, 6 to 9 months on average. It may be longer, it may be shorter, who knows? However, what matters is that the economy is led by the financial cycle. So whatever happens here is going to be reflected in the economy. Slower markets, just like we had in 2022, eventually take a toll on the economy, right? So, and at the same time, the markets which continue to persist higher after the recovery, the bear market is not there anymore, right? We're in the new bull market, and this is confirmed by the relative strength ratio. The new bull market, new yearly highs are being made. This is powerful, very powerful move, right? By the S&P 500. The market is persisting higher. It's persisting higher, right? This is the trajectory of the S&P 500. So if that is the trajectory of the S&P 500, well, we are accelerating. And if we're accelerating, it may happen that the markets can continue to rally. In the ideal hypothetical situation and the model theorem, is that the markets can rally, can continue to move up on average, even when the recession continues, when the contraction recession continues, right? So it's possible. So the markets can pump when there is recession, because those are two different things, two different entities. The financial markets and the business cycle are two different things, and they can work a little bit separately from time to time. So how does it translate to Bitcoin, right? Well, we're looking at the still slightly negative relationship, right? Slightly inverse relationship between Bitcoin and S&P 500. It doesn't happen often. It only happens a couple of times in the past, 3 years, right? In the past 3 years, past three and a half years, I would argue. It's happened only once, twice, 3, 4, 5, 6, 7. This is the 8th time that is actually happening, right? So the 8th time in the past 3 years is it's basically a little bit slightly inverse, right? Slightly inverse means that there's negative coverage, there's inverse coverage, right? So whatever happens on the S&P 500, Bitcoin is going to mimic it slightly on the opposite edge, on the opposite side, right? And there are many, of course, reasons for that. There's not a significant way to tell you, okay, the market has rules, it's going to always be like that, or always going to be like this or that. I wish I could tell you that that would not be true. The markets are full of entropy, inherent chaos that just tends to reshuffle everything that is happening independently on what we think, right? And our opinions are proven wrong most of the time. That's why we want to rely on the left-hand side of the chart, on something that has already happened. Those are facts. Those are facts. Our minds are often only bended in a way, right? To expect something into the future that is uncertain. And this uncertainty is a cause for many behavioral biases and many different irrational behaviors that translate to strange price action eventually. So what it tells me is that on average, on 7-week basis, the correlation coefficient is minus 10, minus 0.10, right? So this is a mild inverse relationship. This is a mild negative correlation coefficient. What it tells me is that it's almost neutral. It's almost neutral. It's slightly negative. Bitcoin on average, on a 7-week average basis, performs slightly in the opposite direction. When the S&P 500 moves up, Bitcoin would slightly go down. When it is the other way around, Bitcoin will take advantage of the S&P 500 when it struggles, right? However, this relationship has weakened a lot, right? It's not at around 1 anymore, right? So whenever there is a strong positive correlation, the markets move together in tandem. They pump together in tandem. This is typically what you want to see for the strong persistent movements, right? We're defending technically the overall strong resistance, prior resistance now turned into support. Beautiful polarity change principle in action. Holding this 200-week price action trend, right? 200-week average trend is basically around 26,300. We've already started inverting and curving up on the 50-week basis. 50-week average basis is curving up after a year and a half long bear market, right? Or year and a half decline on an average basis. So this breakout overall, above, $20,000 eventually was a critical one. And now we're persisting higher and holding this critical support, right? While the critical breakouts, powerful breakouts are happening in the traditional finance. Hope that makes sense. Please let me know, guys, right now. So on the lake fishing, listening to you. Happy fishing, my bro. Happy fishing. Sunny Estoril, beautiful Estoril, of course, Portugal. Beautiful place, beautiful place. I love Estoril. Ben from the CryptoVerse spoke about the possibility of a summer lull. Do you have any thoughts about that? First of all, I would need to know what lull is. Let me Google that real quick. What will lull be? I'm not an English speaker native. Yeah, lull also means stagnancy, right? Quiet. I would say that I agree. On average, the markets are quiet, right? So let me find this really nice chart for you. Let me just pull it up real quick. Come up, come up, come up. There you go. Okay. Here it is. So this is an excellent chart by my great good friend, Jeff Hirsch. Jeff Hirsch is an excellent continuator, is this such a word even? Excellent trader, excellent investors, excellent statistician, on the historical seasonal patterns, right? So he's actually CEO of Hirsch Holdings, publisher of Almanac Trader, editor of Stock Traders Almanac. Beautiful mind, great guy. I highly recommend that you actually follow his Twitter account. And the chart that he showed me is, well, first of all, the 83 to 84 odds, right? Or here's the actual chart pattern from 1939 through 2022, including the bear market. And this is an average performance over, well, in this very case, 73 years, right? With 2023 into the May, right? Record, perhaps it's going to be updated. The May is going to be bullish, of course, here. However, the point is that we are entering the slow 6 months of the market, right? So sleep month, the worst 6 months. This typically happens that you would have from November through May, you would look at the strongest performing months, right? Through November until May, you're looking again at this period of the strongest performance gains on average, right? On average, and we're talking about 20% average S&P 500 return after the midterm bear market. This is the green line. It's the best performer on the record over 73 years, or actually over 84 years, right? This is going in even fatter. And well, arguably, we are in the slowest market. Slowest market doesn't mean that the growth is not present. It means that it's slower, that on average it is sideways, right? It is a period of the strongest month of the strongest year on the record, which is the most quiet, which is the slowest one, right? So that's typically something where you would not want to get over invested. You would not want to be overspending on financial markets, on the risk assets, right? Because if people take time off, we're all human, right? They would take time off. They would take time off with their family, go for a vacation, enjoy their beautiful sun, beautiful weather, not take time in the markets, right? It means translates lower volume in the markets, less demand, and the higher chances that the prices are not going to follow through higher, right? So I perfectly agree. There are very strong chances that the market is going to be slower. It's a safe benchmark to assume. Maybe, because I'm not predicting the future. I have no idea what's going to happen, right? Perhaps I didn't even wake up tomorrow. However, it's good to rely on the long-term benchmarks. Long-term benchmarks are like the temperatures, right? Even though you don't know the temperature during the summer, you cannot predict the future. You're probably not going to take out your winter coat, right? Because it's going to be too warm on average. So even though you cannot predict the future, you're not bringing your umbrella during the driest month, right? Because it's on average lacking rain. If that happens, that there is rain, well, this is more so a deviation of chance, right? This is more so luck or bad luck, if you will, much more than a rule, than an actual pattern. So here, same way, right? I would say that it's just not the best spent money, to get deeply invested in the worst 6 months, which is May through October. It may happen that, there are some wins. It may happen that crypto actually accelerates. There were cases when, for instance, in 2020, when crypto when in 2019, when crypto went fully ballistic. During this quiet time, right? So we'll see. Crypto is a little bit different. I spoke to Jeff Hirsch about that. It's a little bit different with crypto, right? So let's be careful without drawing any fast conclusions, right? So what Bitcoin is doing right now, it's actually, of course, following sideways again trajectory over this critical polarity flip level, right? So $26,000 on average, 25, 26. 25,800 support broken, then rejected on 25,200, 25,200 again, then pulled back, thrown back, supported again, right? So beautiful polarity flip. And as long as we hold these levels, the market, I would say, is not really having much chance to go down to $23,000 to revert to the mean of 200 days price action, right? So we're looking at the head and shoulders pattern, which arguably is not a head and shoulders pattern anymore, right? The market failed to break down to the to the downside. The market has failed. The pattern has failed. That was also one of my main conclusions, right, of the actual thread that I have pinned, right? So the head and shoulders pattern failed. That's the thread that I have on my Twitter. So feel free to go ahead and check it out. The buy signal triggered while still wobbly. Bitcoin gave a critical warning that you shouldn't ignore. So I kindly recommend for everybody to go ahead and have a read. Other than this, we're looking, like I said, at this pattern that doesn't necessarily translate to head and shoulders. I'm actually going to get rid of that, right? So it doesn't translate to head and shoulders anymore because it's failed the breakout. The breakout was present, however, it's failed, right? That was called the specialist breakout right into the 200-day moving average, the adaptive moving average provided by the B Pro baseline, the Burbicator Pro baseline. So we are still holding that. There is a significant slowdown, I should say, right? The market is not really rampant anymore, just like it was during the strongest, March or April moment. This overall wannabe head and shoulders, pattern at first, would slow down a lot, right? It would last about a month or 2 months, almost, right? 2 months of a slower market sideways. It was enough to kind of like give slower price action, slow down to this recency biased, sensitive to the recent price action moving average. It's still giving a reliable framework and reliable data, right? So the critical support right now arguably is 26,500, 26,600. As long as this one is held, this is the actual level provided by the Burbicator Pro baseline. If that one breaks, you have very good chance that the market continues lower towards $23,000, right? That also requires some updating. That was the previous level of 200-day moving average, right? So again, we are looking at the setup where, well, there is this little bit of a trend line, if you will, this declining set of highs, lower highs, low lows as well. There is definitely some slowdown, some overall sideways beam. However, it doesn't necessarily go down, right? It wouldn't go down. It just doesn't comply to go down, if you know what I mean. There wasn't no follow through to the downside. And hence, we've created this failed pattern. The failed patterns trap the overly eager bears right there at the bottom, right? And trapping the bears means that there is liquidity. There are people stuck in their overly premature short positions, right? Typically over leveraged. So what they'll have to do is, if the market moves up a little bit more, they'll have to cover or get liquidated, Eventually, they'll have to cover their shorts, buying back higher, or get liquidated, and eventually may create a rampant move of a short squeeze that eventually may take it over the actual trend line. So the trend line is it's not a magical line that, the Bitcoin is going to care about, then it's going to be beautifully touching and just rejecting or following through, pulling back. It's none of that. Trend line is a line representing a trend. It's a little bit of a visual aid to help you decide about the direction. All right, and clearly the direction has been a little bit downside oriented for the past, at least since April, right? So since April, we've been moving down on average, lower highs, lower lows. Other than this, in a little bit of a broader context, we are moving sideways between $26,000 on approximately $26,000 support, 25,800, whatever that is. Previous highs became the new support. So beautiful technical analysis, classical technicals are being saved so far, right? So again, unless we break out to the downside with a powerful break below 26K, right, which potentially could extend to $23,000, unless we do this, I would say that more so, we're probably going to trigger and try to cause a little bit of an upside pullback. Whether it will happen, I have no idea. We're yet to find out. Regardless of that, my system, my Burbicator Pro trend following system on adaptive ATR breakouts that are otherwise called as the dual price trailer system, the high time frame trailer and the low time frame trailer. current time frame trailer. So we're looking at a bullish setup overall, right? The bullish setup for the Bitcoin has been triggered with the break above $26,000 eventually, right? So we're looking now. Sorry, $26,000 was held here. The 27,300 was broken, triggering the actual buy signal for me. That's me. That's position trading, trend following in the direction of a trend based on adaptive breakouts, filtered by volatility. It's a little bit complex. However, it translates what it translates to with this beautiful, excellent toolkit is that you can actually turn off the daily trailer, which helps you understand the trend in the longer term perspective in a higher context. The sideways price action is very choppy, right? It will get you back and forth and chop you out. However, when the market finally catches on the trend side, it will continue to persist, right? Just like my public trades went here with high six figures, into 6,900, 6,920 was through 22,800. Then from 22,000 all the way here, I got chopped a little bit, right? So it happens a lot. There, $21,000 breakout, approximately $22,000 breakout again, rallied all the way to $29,000, then got chopped a little, right? So sideways environment definitely gives you a lot of chops. However, because you manage your risk, because you keep your losses small, I would assign not and attach no more than 2% account at risk. This is typically where the optimal position size is not the position size. This is the actual optimal risk to avoid the risk of ruin statistically, right? So this is a little bit of a rule of thumb. However, there are some deeper statistics and mathematics behind it. 2% risk account doesn't necessarily mean that you take 2% of your account, right? That you take $2 out of $100. It means that if you lose whatever stake you put on the table, if you lose, so that you don't lose more than 2% of your account, right? So if your stop loss is 4%, right, and you can lose only 2%, so you would definitely not allocate more than half of your portfolio, right? If the stop loss is 2% and you can risk 2%, well, you cannot even allocate your whole portfolio stake on that, right? That's not something that I would recommend necessarily, especially if you're stuck in other positions. Either way, the bullish setup is still relevant. It's still intact, right? It didn't get canceled. There was a little bit of an attempt to break, however, followed by a strong push to the upside. So far, we are bullish still, right? So if I were to comment, right, where we are, I would say that it makes a lot of sense to expect that the potential target for Bitcoin right now is fairly simple. We take the measured rule approach, right? And measured rule technical analysis, classical technicals, would take you the pattern size between the base size between the low, the swing low, and the swing high. So 25,500 approximately. Imagine 25,500, 15,500 at the lower end gives you a $10,000 base size. So $10,000 base size taken and measured from the breakout levels from 25,500 plus $10,000 gives you 35,500, right? This is, of course, like some also impactful region from the price action from the past. And price has memory. Price has memory, ladies and gentlemen, right? So unless we break down sharply and decisively to the downside, potentially triggering $20,000 to $23,000 regions as the potential base of support, right? Unless we do it to kind of like extend it to slower market, unless we do it, I would say that so far we're technically preserved, we're technically safe, we're technically confirmed, and with holding all of the negative impact so far, right? So it's just been neutral past couple of months, right? However, this neutrality happens in the overall bullish context, right? Because we broke out to the upside over critical levels, critical resistance. It's broken, and right now it's being, creating a new base out of that. We'll see what happens. We'll see what happens, right? However, the odds look fairly bullish, and $500,000 may be actually coming on the way. So we'll see about that, right? Definitely lots going to happen with the next FOMC meetings, and whether the Fed stops tightening, which typically kind of like, again, has been a historically strong signal to empower and give a little bit of a fire steam into the market fuel. We'll see about that, right? Ladies and gentlemen, If you are new to the channel, if you're watching that on YouTube, make sure to hit the subscribe button, smash the notification bells so that you stay notified anytime we put out a new video, new webinar. There are plenty of those waiting for you to learn, to trade. And wise man said that the best investment you can make is investment in yourself. The more you learn, the more you will earn. That was Warren Buffett, one of the greatest investors of all time. However wrongly he speaks about Bitcoin. Right? And before I go, you might want to be aware that with our partners at Bybit, we are giving you a chance to get and acquire even a yearly membership for free with the Burb Nest, with my great, beautiful firm operating for the 7th year already. This is the 7th year rolling of the career, right? So this is pretty incredible. The Burb Nest has been here in the bull markets, the bear markets, the sideways markets, the crashes, COVID crashes, minus capitulations, everything. We're still here, we're still growing, we're still persisting, still giving you higher and better quality for thousands of traders. If you want to acquire free membership with premium quality signals, with premium confirmed, backtested, relevant, profitable trading signals, with my CMT accreditation, you can get them under the link below here at theburbness.com/Bybit. Feel free to go ahead and click on the link again, theburbness.com/Bybit. And by following a set of very simple instructions, you're going to be able to unlock a monthly, 4-month, or even a yearly membership with our ref link. Feel free to have a look at the YouTube description, right? That's where you're going to find the link that I'm talking about, or go ahead and type it in theburbness.com/Bybit. You're going to have access to premium quality signals for free. That's all I've got for you. Congratulations for staying up with me on the show. You are one of the people who are going to make it. Give yourselves a better chance. Sign up with us. God bless you all. See you around. Have a beautiful weekend. Bye-bye.